Welcome to the Deep Dive. Today, we're zeroing in on a strategy that often gets attention when the stock market feels a little wobbly.
Yeah, dividend-paying stocks.
Exactly. And we're using an article from The Motley Fool as our guide here. It just came out yesterday, April 26th, 2025.
Right, the one titled, Four Surefire Dividend Stocks to Buy in the Stock Market Sell-Off.
That's the one. So our mission today is pretty straightforward, really. We want to unpack the reasons why these stocks might be appealing now.
And dig into the specifics of the four companies they highlighted: AbbVie, Amgen, Bristol Myers Squibb, and Zoetis.
Right. And this is relevant for you listening because, well, in a potentially choppy market, understanding strategies for maybe stabilizing your portfolio.
Or just identifying companies with solid long-term prospects. That's pretty crucial, wouldn't you say?
Absolutely. So this deep dive should give you a good shortcut to the arguments for dividend stocks in a downturn, plus some concrete examples.
Okay, sounds like a plan. Where should we start? AbbVie.
Let's do it. AbbVie. Big drug maker, immunology focus. Now, the article notes they've had challenges, patent cliffs, some clinical stuff.
Yeah, those are sort of standard hurdles in pharma, you know?
True. But their financials seem to hold up regardless. So what's the secret sauce there?
Well, a big part of it seems to be their newer drugs really taking off. Think Skyrizi and Rinvoq for autoimmune conditions.
Oh, okay. And the article mentioned management actually upped the guidance for those.
They did, just recently, boosted the 2027 combined forecast to over $31 billion. That's a pretty strong signal of confidence from them.
So it's not just resting on past successes. They've got these massive growth drivers coming through.
Exactly. And it's not only those two either. The article also mentions Qulipta for migraines.
Oh, yeah.
And even established names like Botox are still kicking in significant revenue.
Botox is still going strong, huh?
Apparently so. Plus, they have a pipeline, new candidates coming through. They aren't standing still.
Which is key in pharma, right? That constant cycle of innovation. You lose a patent, you need something else ready.
Precisely. It shows they can navigate those inevitable patent losses, which speaks to their longer-term prospects.
Okay, let's talk dividends specifically, because that's the theme. AbbVie's record. It's pretty impressive.
It really is. 53 consecutive years of increasing the payout.
Wow. That includes their time as part of Abbott Labs, right?
Correct. But still, over half a century of increases. That screams commitment to shareholder returns.
It really does. It suggests a fundamental financial strength.
And a management philosophy that prioritizes giving back to investors. Plus, look at the yield.
Right. The forward yield is 3.9%, according to the article.
Which is, significantly higher than the S&P 500 average. I think that's around 1.3%.
Yeah, much higher. So that income stream looks attractive, especially if market growth is uncertain.
Definitely. A key part of the appeal.
All right, let's move on. Next up, Amgen.
Okay, Amgen. Another big name in pharmaceuticals, pretty diverse portfolio.
Yeah, and the article mentions a recent a bit of a stumble with their weight loss drug candidate, Maritide.
Right, the phase 2 trial data, it didn't quite hit the bullseye on all expectations, caused a bit of a dip in the stock.
But the piece emphasizes that Amgen is much bigger than just one drug, right?
Yeah.
Even a potential blockbuster like that.
Absolutely. That's key perspective. The market can overreact, especially in hot areas like weight loss. But Amgen has over 10 existing blockbuster drugs.
10 drugs already doing over $1 billion a year.
Yeah. So Maritide, it still shows promise, but it's definitely not their only horse in the race. Far from it.
So what are the other key growth drivers mentioned?
Well, they highlighted the asthma medicine, Tezspire. That's a partnership with AstraZeneca.
Okay.
And Tepezza. That's the only FDA-approved drug for thyroid eye disease.
Sounds like niche but important markets.
Exactly. Addressing significant unmet medical needs. That kind of focus helps underpin their financial health and, future growth.
And that financial health obviously supports the dividend. Now, this part caught my eye. They only started dividends in 2011.
Yeah, relatively recent compared to AbbVie.
But since then, they've increased payouts by 750%.
Insane, right? That's not just steady growth. That's, as you said, like a rocket ship.
What does that kind of growth tell you?
It tells you the company is, 1, very profitable, and 2, very committed to sharing that success. It suggests real confidence in future earnings.
Makes sense. And their yield is also pretty solid.
Over 3.5% forward yield, so another strong income component. And the expectation, according to the article, is that they'll keep raising it.
Good to know. Okay, third company, Bristol Myers Squibb.
Right, BMS, another pharma giant.
Now, this one seems to be facing some pretty significant patent expirations head-on. Opdivo and Eliquis by the end of the decade.
Yeah, that's a big deal. Those are massive drugs. Losing exclusivity there means billions in potential lost sales to biosimilars eventually.
So how do they deal with that? Is it similar to AbbVie?
It is, in principle. Patent cliffs are just part of the business. Bristol Myers has navigated these before, though. They have a history of bringing new drugs online or acquiring them to fill the gaps.
Through R&D and deals.
Exactly. It requires constant effort on research and business development.
So even with these blockbusters facing competition, they're pushing new stuff through. The article mentioned Reblozyl.
Yeah, for anemia in certain patients, and Opdualag, a cancer medicine. These are part of that next wave.
And they have others in the pipeline too, continuously launching things.
That's the model. Keep the pipeline full. Now, the article does note the stock itself hasn't been a star performer lately.
Right, but it frames it as maybe a solid long-term pick, especially for income investors.
That seems to be the angle, suggesting perhaps the market is a bit too focused on the patent expirations and maybe undervaluing the newer drugs in the pipeline.
And for those income investors, the dividend is definitely noticeable. 5.1% yield.
Yeah, highest of the four we're looking at today.
And they've grown it substantially too, nearly 68% over the past decade.
Also very solid growth. So the takeaway seems to be you might need a bit of patience with BMS as they navigate this transition.
Okay.
But that high yield combined with the growth history makes a strong case for income seekers willing to wait for those newer drugs to really ramp up.
Makes sense. Patience for yield. Okay, last one, Zoetis.
Zoetis. Now we're shifting gears a bit. Animal health.
Right. The world leader in animal health, the article says.
Yep. Dominant player.
They apparently had a bit of a slower start to the year, some guidance issues, and more competition for Apoquel.
Yeah, Apoquel is a big one for them, treats allergic itch in dogs, so increased competition there combined with maybe slightly softer guidance, ruffled some feathers.
Okay, but the article stresses their overall track record is still strong.
Very strong. I mean, think about this. They have 15 different products that each bring in over $100 million a year.
15, wow. That's diversification.
Exactly. And their whole portfolio is huge, like 300 product lines across different therapeutic areas for animals. And historically, they just grow faster than the industry average.
So even if Apoquel faces more competition, the core business is pretty robust.
Seems that way. And the article notes Apoquel itself still has growth potential. Plus, they have new approvals driving growth.
Like Solensia and Librela for osteoarthritis pain.
Right. Solensia for cats, Librela for dogs. These are seen as major future revenue streams, and they keep focusing on launching new things.
So, similar theme. Innovation and a broad portfolio provide resilience.
Precisely. Their diversity across species and conditions, plus that R&D focus, are huge strengths in the relatively stable animal health market.
Now, the dividend story for Zoetis. They've also shown impressive growth, right? Around 500% increase in payouts over 10 years.
Phenomenal growth again. Really strong history there.
But the current yield is lower than the others, 1.4%.
It is. Definitely the lowest of this group.
However, the article emphasizes stability. Says it's unlikely they'd cut or suspend the dividend. What's the read-through there?
Well, it suggests that while the starting yield isn't as high, that combination of massive past growth and high confidence in future payments makes it attractive.
So maybe for investors looking for dividend growth and stability in that specific sector rather than just high current yield.
Exactly. It offers exposure to animal health, which is generally less volatile than human health, alongside a dividend that's been on a steep upward climb and seems secure. It's a different flavor, but still fits the dividend theme.
Okay, great. So let's try to pull this all together. As we wrap up, the core idea seems to be that dividend stocks, especially from established companies like these,
AbbVie, Amgen, Bristol Myers Squibb, Zoetis.
right. They can offer a measure of maybe stability or resilience when the broader market is shaky, because the underlying businesses are often quite strong.
Yeah, and each of these four has its own specific story. You know, different growth drivers, different dividend profiles, different challenges, but all rooted in essential industries.
And for you listening, if you're trying to get up to speed quickly on investment ideas for a potential sell-off, well, these examples give you some solid rationale.
Understanding their strengths, their hurdles, how they reward shareholders, it arms you with better info for your own decisions.
Definitely. So here's a final thought to leave you with. We've talked about consistent dividend growth, strong market positions in vital sectors like healthcare and animal health.
Mm-hmm.
So how might consciously including these kinds of dividend-paying stocks within a diversified portfolio impact your long-term wealth building.
And maybe your sense of financial security, especially given, well, all the ongoing economic uncertainties out there.
Exactly. It's something worth pondering, as you think about your own investment strategy going forward.